Markets have perhaps been too optimistic about rate cut assumptions, but economic data has generally come in strong in the United States. And our guest says we might have to consider a no landing scenario, aka a no real slowdown for the economy. We are joined by Justin Elliott, portfolio manager at Caldwell Investment Management. Justin, it's great to see you. I like that, a no landing scenario. That would mean the US economy really doesn't slow down that much?
Yeah, I'll dive into that a bit more. I think the consensus right now is still for a soft landing, but the investors are much more divided about where we are in the business cycle and therefore when a recession might materialize. And so a lot of investors have been expecting a recession for over a year now, but the macroeconomic data has been extremely robust. There was a Bank of America survey recently that showed only about 5% of investors view that we're currently in a downturn. The remaining opinions were roughly equally split between early cycle, expansion, and late cycle. And so for us, one of the biggest risks is a more severe recession developing quickly. But to your point, we're also starting to think, just given how strong those macro releases have been, that a soft landing turns into more of a no landing scenario. And for those that aren't familiar with the term, it basically is when you have positive economic growth, but the rate of inflation is persistently above where the Fed's 2% target is. And so essentially that means a higher for longer interest rate environment. And we don't see that risk being correctly priced in here. So, we're not predicting when there's going to be a recession, but we do try and think about those out of consensus scenarios and how that would impact our portfolios.
That's it. So rates stay higher for longer. Obviously not great for leverage firms and not great for real estate either, I guess.
No, and they've been having issues for quite a long time. I mean, we even hear on the industrial side, a lot of projects that were planned out, mega projects, have hit snags because of higher funding costs. So, that does tend to push some things out. It reverberates back to companies that are depending on projects getting started now. So, yeah, I think for, markets generally, lower rates are better, but there definitely are certain sectors where, they really want to see those rates come down so activity can pick up again and projects can get started.
You reckon, looking at the valuation on the S&P 500, it's in the top 10%, it's in the 90th percentile or above of its valuation over the long term.
Yeah. It's in the top decile basically over that long-term valuation average. We think the markets are have been too optimistic on their rate cut expectations. And again, the Fed has come out with warnings that the market doesn't seem to really be paying attention to. We thought those 6 to 7 cuts that were being priced in at the beginning of the year were a little bit too aggressive given the macro data that we saw. And so again, we don't really think that risk is being correctly priced in here. I think if you were to look at this past earnings season, right, the magnitude of beats on the aggregate level for the S&P was much smaller than it's been in recent quarters. And so that magnitude of beats is smaller, and companies that didn't hit their expectations, that missed expectations, sold off quite hard. And so for us, that's a signal that expectations are elevated here. There still is quite a bit of optimism, and we think that's a risk that might have to come down a little bit, and with that, the markets could potentially come down too.
You have a couple of stocks that you like the look of. One is FTAI Aviation. What are they all about?
Yeah, so they're an aircraft leasing company. They basically lease the full aircraft, and they also do engines separately and the maintenance of those engines. And so with the rebound in travel post-COVID, a lot of the airlines are seeing quite a pickup in their demand for travel. And for FTAI, that means they're seeing higher lease rates for their equipment. That's also been helped out by some issues with Boeing, Pratt & Whitney with their next generation planes and engines. So as the timeline for those gets pushed out for delivery, airlines continue to rely on their older equipment and look to, lease planes that they're familiar with. So that's been a big boon for FTAI. But what differentiates them, I think, from peers theirs is that they have that in-house engine servicing capability. And so they've been able to more cost effectively and efficiently repair these engines, and that helps the airlines save money. So a program that they've developed recently is seeing very strong uptick from the airline customers. It's leading them to higher cash flows. And so that's contributing to, we think kind of this positive re-rating that we're seeing.
Applied Materials, long a player in supplying the chip industry, stock up more than 80% in the past year, but you do see upside.
Yeah, we do. And we think there's quite a good growth outlook for the semiconductor industry and semiconductor manufacturing equipment. On the semiconductor side, it's things like EVs, which have higher content, for example, than your ICE vehicles. It's the Internet of Things, right? It's the electronification of previously analog products to digital that's going to drive that growth. But on the equipment side, it's countries realizing how important it is to have this manufacturing capacity close to home, right? Because of all the supply chain issues that we saw over the last couple of years. And so we think countries like China, Europe, the US are really trying to develop a robust semiconductor manufacturing ecosystem within their own borders. And that's supporting a lot of the growth for Applied Materials. So we do see, continued growth there for medium to long term.
Just finally, Macys, obviously department stores have struggled over the past decade and more, but you have an interesting observation here on these cutbacks at Macys.
Yeah, I think it's no surprise to anyone that Macys has really struggled to adapt to this e-commerce environment and kind of changing consumer expectations. So we do see these restructuring actions as a step in the right direction, and them focusing more on the luxury customer, who is, one, a little bit less price sensitive, a little bit more robust through tougher economic times, is going to hold up better than the lower end customer. And we've seen a ton of competition, not only from incumbents like Amazon, Walmart, Target, but also your off-price retailers like TJX, for example, and more recently, a lot of your Chinese competitors like Temu and Shein that have come in and are really starting to rapidly take market share. So focusing on your luxury customers, we think that's a good play. Trimming their store count, like you said, 30% of the Macys brand, those were underperforming stores, right? So 30% of the footprint, but less than 10% of sales. We think there's going to be a nice change in efficiency there, and they're talking about cost synergies from that over time. And so that should lead to higher cash flow profile, which they've also spoken to. And we think that's, the main driver of the result we're seeing today in the stock price. Now, again, they don't have the greatest execution track record. It's going to be up to them to prove that, but we think it's a step in the right direction today.